Are you paying more taxes than you should be? In this episode, tax expert Mike Jesowshek, he's a CPA that reveals how small business owners can uncover hidden deductions, restructure for maximum savings, and rethink their entire tax strategy. So you'll discover practical legal methods to keep more of your hard-earned cash without the stress of tax season surprises.
Welcome to the Lead Machine Growth Show, where you will discover how to tackle your tech, master your message, and design your dream. Paul Guyan, the mastermind behind the Lead Machine, introduces you to trailblazers who inspire you to implement life-changing solutions and systems you can model to nurture your leads and get your offers seen by your ideal clients who will invest in themselves and you. Be sure you visit our website at www.leadmachinegrowthshow.com. While you're there, subscribe to us via your favorite network. Now, tune in and get ready to transform your vision into reality.
Welcome to the Lead Machine Growth Show. I'm Paul Guyan, your host, lead machine coach, and the founder of the Lead Machine Marketing Group and Mastermind. And I'm dedicated to helping you tackle your tech, master your message, and design your dream life. And so whether you're just starting out or if you want to take your business to the next level, let's get this conversation started and turn your dreams into reality. Mike Jesowshek is a CPA, entrepreneur, author, and host of the Small Business Tax Saving Podcast. You might want to check that one out for sure. He's helped thousands of entrepreneurs understand and implement simple yet powerful tax strategies that minimize taxes legally. His mission is to break down complex tax rules into everyday language so dumb business owners like me can understand, who can confidently make smart financial decisions year-round, not just in April. So, Mike, thank you so much for coming on the show today. I appreciate your time and your talent.
Yeah, Paul, thanks for having me. Look forward to diving into it.
Yeah, did I get your name right?
You did. You know, it's funny because it's a tough name, but it looks worse than it actually is.
It does.
I'm someone that's really bad with names. And so normally someone will tell me how to say their name and they'll tell me how to not say their name. And for whatever reason, what sticks in my head is the not part.
The not, yeah.
So, I'm always impressed when I meet someone, they're like, how do I say your name, by the way? And yeah, they do a great job, which you did. So.
Well, thank you. But, I cheated because I looked up and I said, how the heck am I going to say this guy's name? So I went and looked at your YouTube channel and you had a channel intro, which right in the first 20 seconds, you said, my name is Mike Jesowshek. And I did it wrong. But I listened to that over and over and again. I said, gosh, is he saying Jezo? Anyway, thank you so much for being here. That's extra effort so I can get this thing kicked off. So what does tax planning actually mean and why is it so critical for small business owners?
Yeah, so many people have a misconception of what tax planning is. And so tax planning, very simply, is what can I do to put into place to make sure that I'm paying the least amount of taxes as legally possible. And when most people hear the word tax, they think of, I see my accountant in January, February, March, or April. I give them some information and I file my tax return. And then maybe I see them again in June, July, August, September, one time somewhere in there. They tell me, okay, how's the business going? Let's submit some estimated tax payments. And so we do planning around, what payments I need to send in. And that's what people a lot of times think of what planning is. It's, my accountant says, make this payment as an estimated tax payment and go along with it. But what I found is talking to small business owners is that the planning piece is completely different. Tax planning is what can we do from January to December? What things can we change in our business? What investments can we make? What things can we do to lower our tax bill so that when we do see our accountant in April, whatever we've done, we've already put the work in at that point to make sure that whatever that tax bill is, if we have one, it's as low as we legally can get it. So it's this understanding of, okay, what concepts are out there, and then how do I go ahead and implement those? Because the government has written the tax code for a reason, and the government, what I always say, wants certain things, but they can't go out and do it. So the government wants a growing economy. The government wants people to be employed. The government wants good, affordable, quality housing, but the government can't employ the entire country. The government can't go out and build all this affordable housing. So how do they get it done? They create incentives for us as citizens to go out and do it. And those incentives are in the forms of tax breaks. And so you'll start to see, as we look into different tax codes, different strategies, you'll see that there's an incentive. There's a reason why the government allows this. And it's because they want something out of it. In order to encourage us as business owners, as citizens to do it, they say, hey, we'll give you a tax break if you go ahead and do this thing.
Gotcha. And so how do you structure your, I guess your entity, but your way of doing business on a day-to-day basis so that you can fulfill that? Obviously, at some point you need a plan and you might need some expert help. But what entity or structure that do you recommend for that?
Yeah, so two different things there. One, when we talk about a business, I always say we want to have the foundation. We want to make sure we have a good foundation that we're growing that from. So whether we're just getting started, or we've been started for a while, we want to build a foundation that is meant and available to grow with us as our business goes. And a lot of people they have an idea, they want to get started, and they hit the ground running, and then 3 years later they come back and be like, oh, okay, business is booming, things are going great. This is way bigger than I ever expected it to be, but it's a mess and nothing's being done right. I'm paying way too much in taxes. And so that's why I always talk to business owners of setting that foundation from the beginning. And that foundation is an entity structure, whether it's a sole proprietorship, which is an entity structure in and of itself, but it's no formal legal type of entity structure, or an LLC or a corporation. And so what I always tell business owners is I recommend opening up an LLC for your business. One, an attorney can talk to you about the legal protections that it can bring, which is really good. But it also is a solid foundation so that when your business grows, you have avenues to implement different strategies that would not be available if you had an LLC. So if you have a sole proprietorship or an LLC, there's no difference in the tax perspective of both of them. They're both taxed exactly the same way. But what that LLC opens up is different opportunities for tax strategies that we can put on top of it. So think of something like an S corporation. A lot of people might have heard of this idea of an S corporation and the value and the tax potential savings behind it. An S corporation is good when it makes sense. And so we don't want to rush into something called an S corporation. But what an LLC can do is an LLC is kind of that insurance policy so that when an S corporation does make sense, when our business does grow to a point where it makes sense, we can go back on that. So that's kind of that foundation from an entity perspective. But a foundation from this idea of tax planning in this concept of tax planning, I always say comes from kind of this root idea or root kind of mindset shift. And this is after tax versus pre-tax spending. And so many people, and Paul, I'm sure you've heard this from friends just talking at the end of the year, like, yeah, I'm going to go out and buy a new truck to help lower my tax bills this year. I'm going to go and buy something that I don't need because it's going to help lower my tax bill. And while that's true, it will lower their tax bill. If they don't need it, they're actually losing money on that deal. So let's say we buy something for $100 that we don't really need, but we're going to lower our tax bill. And if you're in the 24% tax bracket, you saved from that $100 purchase you bought, you saved $24, but you're out $100. So sure, you got a discount on what you maybe bought, but if you didn't really need it, it didn't really provide you true cash on cash savings. And so I talk about this concept of saying, how can we move after-tax dollars into pre-tax dollars? And after-tax dollars, the best way to explain this is, as a W-2 worker, if you work for somebody else, you have a paycheck, you have your gross wages, your employer takes all these taxes out, and then you have your take-home pay. And when you take that take-home pay, you go out and pay for your mortgage, you pay for your rent, you pay for your food, you do everything with that. And I consider that all after-tax spending because that's money that's already been taxed. But as a business owner, we have sales or revenue, and then we have all these expenses that go into it, and then we come up to our profit. And our profit is what we get taxed on. And so any spending that we do inside of our business prior to that profit number is considered pre-tax spending. It's spending that we're doing prior to any funds being taxed. And so our goal when we talk about this idea of maximizing deductions is not going out and buying something that you don't truly, really need. It's saying, how can I move spending that I'm already doing from after-tax spending into pre-tax spending. And that mindset shift, that concept is something that kind of stems and starts so many different strategies that we can discuss. And it all kind of stems from that simple idea and then expanding from there.
So that's a lot to unpack there. But a couple of things I just noticed was okay, you've got the entity structure. So we've got a lot of people that I know that I work with have either an LLC or an S Corp or some sort of corporation. And so what are some of the advantages, the tax advantages for that you said there were some opportunities that you might not have with a sole proprietorship? And I guess the pre and post tax spending is one of those things, right?
Yeah, from a sole proprietorship, so whether you're a sole proprietorship or a single member LLC, tax exactly the same. So that initial opening up an LLC does not provide you any tax breaks at all. So that after tax versus pre-tax spending, that's available to LLC, that's available to sole proprietorship. That's just that concept of doing those different things. But where an LLC opens up the door is it allows the opportunity for an S corporation when an S corporation makes sense. So as a sole proprietorship or a single member LLC, you get hit, you pay your normal income tax rate and any profit from your business, but you also pay self-employment taxes on 100% of your profit. And so that's 15.3%. So let's say you make $100,000. You're going to pay your normal income tax rate, whatever bracket that is from your business, plus you're going to pay an extra $15,000 in self-employment taxes on that $100,000 that your business profited. And so that self-employment tax is something that a lot of people aren't used to. It's something that can really kind of become a hit and add up to a large number. I was just reviewing a return the other day that someone had $30,000 in self-employment taxes. And so the way that we help minimize the amount we pay in self-employment taxes is by utilizing something called an S corporation. And an S corporation is not an entity type. It's not something that we organize at the state level. We would organize an LLC or we would organize a corporation, and then we simply elect for that LLC or that corporation to be taxed as an S corporation. And the only thing that changes, or the main thing that changes, is it helps minimize the amount we pay in self-employment taxes. Because now, instead of paying self-employment taxes on 100% of our profit, we're only paying it on a portion. And with an S corporation, you're required to pay yourself a reasonable salary for the work that you're doing. So let's say in that example of that $100,000 business profit, let's say that, easy numbers, we say that a reasonable salary is $50,000, for that person, for the owner, what they're doing for that business. If it was $50,000, we're still going to pay self-employment taxes on that salary. It's not called self-employment taxes, but it's essentially the same numbers. It's FICA taxes. So we're still going to pay that self-employment tax on our salary, but we're going to avoid it on any income we make over and above our salary. So if we, in that example, first example, making $100,000 a year as a sole proprietorship or a single member LLC, no S Corp election, we're paying our regular income tax rate plus 15% on $100,000. That's $15,000. If we take that same entity, that's an LLC, and we elect S Corp status, and we determine that a reasonable salary is, say, $50,000, that means we're going to have a salary of $50,000, and then we're going to have the remaining profit of $50,000. We still pay our normal income tax rate on the full $100,000, but we only pay self-employment taxes on half of that money at that point. So instead of paying $15,000 in self-employment taxes, now we're paying $7,500 in self-employment taxes. That's a direct cut, and that's a direct in-your-pocket savings year after year after year. So the S corporation can be super powerful because of that ability to help lower the amount that you pay in self-employment taxes. But the reason that we don't do it off the bat is that this S corporation has two downsides. One, you have to pay yourself payroll, W-2 payroll. You're an actual employee of your company, and that costs money. We recommend using a software. Don't try to do it on your own. Use a software. It costs a little bit of money. The second piece is an S corporation is a little bit more of a complex tax return. And that complex tax return is just going to cost a little bit more to, whether you're self-preparing or having someone prepared for you, it's just going to have some additional cost to it. And so because of those two costs, we say, hey, if you're making $20,000 a year, $10,000 a year, you're going to see self-employment tax savings with an S corporation, but those savings are going to get eaten up with the additional costs that you have. And so we typically say an S corporation makes sense once you're hitting about $50,000 or more in profit. But the reason that I say an LLC is a good structure is because we can't turn a sole proprietorship into an S corporation. You have to have a physical entity structure in order to elect S corp status. So if we're running as a sole proprietorship, doing a bunch of money, we're saying, oh yeah, I want to take advantage of this S corp. Well, we can't. We have to open up an LLC first. And so I always recommend people having an LLC set up because it kind of serves as an insurance policy of when we get to the point where our business is growing to the point where an S corp makes sense, we already have the LLC set up. We can elect S corp status, and boom, we can start to see those self-employment tax savings right away.
Wow. Totally understand that. Thank you for making that simple for us business owners who just, they think of taxes and they go, oh my gosh, I don't know where to start. So what are some of the deductions and that small business owners miss or maybe underutilize, and how can we make smart investments with that profit to make that self-employment taxes be not such a burden?
Yeah. So, if we look again at this idea of after-tax versus pre-tax, that mindset of saying, how do I take spending that I'm already doing, but instead of using after-tax dollars for it, now I'm using pre-tax dollars for it. I'm finding a business purpose and bringing it into the business. If we use that concept, it leads into a lot of different strategies. So just think of something like a home office deduction. That is black and white in the tax code. Everybody should be most businesses should be taking advantage of the home office deduction to some extent. And the home office is the great example of that. You're going to have a home that you're living in, and you're going to pay the expenses for that home, whether you're a business owner or not. But now as a business owner, you get to take a portion of those expenses and take them as a business deduction. So let's say that 10% of your home is business related. Now, instead of paying 100% of your home costs with after-tax dollars, you're only paying 90% of it with after-tax dollars, and 10% of it you moved into pre-tax dollars. So that's a great example. Same thing, you could talk about automobile and cell phone and internet and all those different things like that. But where you start to get even more powerful is we look at different things like, let's say, hiring your kids in your business. And, a lot of people, I say this, if you have kids over the age of 7, every business should be hiring their kids to some extent in their business. And, as a father, I know that kids are not cheap. We're always spending various different things on kids. And, think of things like send them to a basketball camp or a baseball camp, or maybe they're going to an amusement park with friends. We're always giving them money to do these different things and signing them up for different stuff. But we're always using after-tax dollars for that. But what if there was a way that we could find our kids to do something legitimate in our business, pay them a reasonable rate for the actual work that they're doing based on their experience and everything else, but they could be not only getting to know the family business a little bit, understanding this concept of, hey, if I work, I can earn money. We're doing all those great things. But by hiring our kids in our business, now we can get a business deduction for those items, and they more than likely are paying no taxes on that income that they're receiving, because it's going to be under the standard deduction. So now we're moving spending that we're already doing. Now they can go out and pay for their basketball camps, their baseball camps, their amusement parks with friends. They can go out and pay for that stuff with the money that they've earned from working with us. And that's a great example from we're going to support them anyways. We're going to put them through these different programs anyways. But instead of using after-tax dollars, now we hired them in our business. We did it the right way. We did things the right way. And we're using that, turning that after-tax spending into pre-tax spending.
So that makes me think of, okay, what can I teach my kids to do, because they don't really have any interest in my business, but that would be an advantage because I'm already giving them money and supporting them. And my youngest son lives with his mother, and I give her $200 or $300 a month for expenses, and he's doing nothing for it. So I could have him do some research. I could have him review my podcast. He could make notes on it and tell me what he thinks about it. But how much value is that? But that's something that he could do. But it just makes me think of how can I make that? It's that's $250 a month or $300 a month that I'm just handing out.
Yeah, that's a good question, Paul. And this is a conversation that I always have, because as soon as I talk about let's hire your kids, they're like,
yeah,
my kids can't help in my business. I'm a solo attorney. What's my kid going to do in my business? And so we start to go down this route of saying, okay, we want to think of this from a multifaceted approach of where are the benefits. One, we're teaching our kid about this idea of working for a living. The second piece is there's obviously some really good tax benefits here. And then the third benefit is like, how can it help your business? And so I often say that sometimes I had a conversation with an attorney once. And he said, Mike, I'm a referral only. I have the same clients and they just send me clients. I don't do advertising. I don't do anything like that. There's nothing my kids can do in my business. And I told them, I said, well, what if they started to post social media posts? What if you created a social media account? They would find articles and different things related to your business, or they'd post different things on your social media. Is that going to hurt your business? I know you're a referral only and you don't need advertising or anything like that. That's fine. But if you just had a social media profile that you were posting stuff to, is that going to hurt your business? And the answer is obviously no. It's not going to hurt my business. Do you need it? No. But hey, we're looking at it as a different opportunity. It's not going to hurt your business. It's an added benefit. And the true real cool benefit is the tax savings piece. And so your example is right. Like, if you were to hire your son as an example, could they look at previous podcast recordings and do a review of it? Say, hey, is there anything that, you had the audio version. Is there anything that sounds a little weird that we need to touch up? Or once a podcast goes up live, maybe he spends the first 45 minutes every week listening to that new episode and saying like, oh, Dad, I wanted to let you know about this different thing. Or, there's different things that we can get creative to. And sure, we're not paying them $10, $20, $30, $40,000 to post on social media. That's not what we're talking about. But if we can turn $1,000, $2,000, $3,000 that we can move from spending that we're going to do after tax spending into pre-tax spending, we get a business deduction. They likely pay no income taxes on that income. That is a complete shift in a really cool advantage that, sure, would you pay somebody to do that if it wasn't your child? Maybe not.
Yeah. Absolutely, I would. Absolutely, I would. With your lawyer example, I mean, he's not thinking of the big picture in that case. I mean, because that social media presence boosts his credibility. And if he wanted to sell his business or move it to someone else, if he had something in place, he'd have more value in his business. So his business would be more valuable.
Yeah.
And
So
his clients may like that content too,
Right, exactly. So it's just thinking outside the box a little bit. Sometimes it's not very obvious to you on what your child can do for you. But if we start to kind of think outside the box and think like, maybe even I tell clients sometimes, track by the minute what you do for like 3 days. And is there anything that's like it's taking your time, but it's very, very simple, very easy to do that your child could do for you every morning? Or, prepare this, or get you a list of the top 5 articles in your industry, the top 5 news stories in your industry from yesterday. And they're compiling it and sending it putting it in a folder on your desk when you get there in the morning, whatever it might be. Like, there is different ways that we can think outside the box to find them something to do, and don't have to assume that this is like a $10, $20, $30, $40,000 job for them. It can be as little as $600 a year. That is a shift that is helpful. And then we like to combo this idea of hiring our kids is, now that they have earned income, we could fund a Roth IRA with that money that we're paying them. Because the downside of a Roth IRA is you don't get a tax deduction when you put money into it, but it grows tax-free and withdrawals are tax-free in retirement. But if they're not paying any income on any taxes on the income that they're making, we don't need a tax deduction going into this retirement account. And so we could fund a Roth IRA at a very young age that is just going to grow and grow and grow. And they're going to have a pretty nice nest egg, even if you funded it for $5,000 for 5 years at the age of 10 to 15. Think of that. That's $5,000, 5 years. That's $25,000 that we're putting into it. That's going to grow for 40 years, 45 years, tax-free with tax-free withdrawals. That's just kind of taking one strategy and piling it on top of another strategy.
Well, I love that. And what are you doing for your kids? And how do they help you with your business? Or they
I have a 4-year-old, a 2-year-old, and a 6-month-old. So they're not doing much. I haven't paid them yet. This is the year that I'm thinking, okay, I'll find some. Typically, we say the age is about 7, just because tax court case has supported the age of 7, and I'm good with that. But I talk to clients all the time that come to me young and say like, hey, we did a photo shoot. Yeah, let's pay your child for a photo shoot. What would it cost to hire a baby to do a similar photo shoot that you're using those photos in your business? Let's find something to do. So, I'm thinking about hiring our 4-year-old with just some cleanup, different items around the house and stuff like that. I authored a book in January, so he's been helping kind of stuff envelopes and putting, bookmarks in them and putting them into
Yeah.
mailers and things like that. So, but I mean, at the age of my kids, I'm talking maybe $500-600 a year as a max from that point.
Yeah. And so are you doing the Roth IRA deal, or are you just waiting for the right time? Or are you doing that already?
Yeah, so that's exactly what I do is when I hire my kids, instead of using it to pay for basketball camps, I'll still kind of pay for that using after-tax dollars, but I'll use that
Yeah.
Roth IRA from their earned income now to fund that Roth IRA. And I kind of look at it as a secondary, think of it like a college fund. Because here's the cool thing about Roth IRAs that people don't always know about is that a Roth IRA, you can withdraw the principal from it, no tax, no penalties, no questions asked. So let's say that I put $5,000 into a Roth IRA for 5 years. That's $25,000 that's sitting in that Roth. And let's say my child gets to college and now that Roth is worth $40,000. I can withdraw the original principal amount, that $25,000 that I put into it. I can withdraw from that IRA tax-free, no questions asked, even at the age at a young age of 21 or whatever it might be. Now, I wouldn't encourage that. I'd much rather see that grow tax-free and withdraw tax-free in retirement. But that can serve as sort of a backup emergency pot that child can access down the road.
Yeah. 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 I love it. This is great stuff. So you emphasize mindset when it comes to taxes. What are some of the shifts that business owners to do? I know we've touched on a few, but how do we think more like a tax savvy CEO?
Yeah, the reason that I ever got into tax planning was because I was a business owner that ran into tax issues. And every time that I would ask and I ran an accounting firm at the time, but all we did was bookkeeping accounting. We didn't touch tax just because I didn't have a background in tax. But I would refer people out. And when I would refer to other accountants, I would ask them, like, how do I do this? How do I hire my kids in my business? And I would always hear, well, it depends. I need to know this, this, and this, and I need to know all these details, and then I can tell you how to hire your kids in my business. And I got really frustrated with that because I, as a business owner, would be like, sounds like too much work, probably not good enough benefit. I'm going to spend my time elsewhere. And so if I'm thinking, if I'm doing that, probably everybody else that I'm working, all the other business owners are hitting that brick wall of it depends. Sounds like too much work. Sounds like something that they don't want to deal with. So they go down the other way. And so what I ended up doing was starting to research on my own, like, okay, it depends. And it does depend. So I'm not saying it doesn't depend. It does depend. But through my research, I found that when you talk about different tax strategies, it's 90% the same for everybody. So this concept of hiring your kids in your business, what you need to do it correctly, what you need to document and put on file, how you actually do this process of hiring your kids, that's the same for everybody. So I say 90% of the strategy is the same for everybody. The part that depends is that last 10%. If I'm an accountant and how I hire my kids is going to look a little bit different than a plumber. And what I pay my kids is going to be a little bit different than what someone that has a 17-year-old will pay their kids. And so that's the part that it depends. But my goal is to say, how do I get people 90% of the way there? So that instead of going to your accountant and saying, hey, I saw this cool thing, how do I hire my kids? You're going to them and saying, okay, I got little Johnny. Little Johnny's going to be doing this for me. Here's a rate that I determine will be good. We're planning about 2 hours a week, and here's what we're looking at. And now they go to their accountant with that and say, hey, can you look over this? What am I missing? What are the different things? And now the accountant's not pushing them away. They're saying, wow, you got everything in front of you. You got this pretty much done. Let's button up these last 3 things, and let's go ahead and start this process. And so that's kind of that mindset shift that I've been working on with business owners ever since I started getting into this tax side about 10 years ago, is saying, like, how can we break this down, make this apparent to all business owners, the 90%, so that they're not hitting that brick wall at 0%.
Wow. Great stuff. I love it. What, as we shift to maybe some common pitfalls, what do you think most entrepreneurs or many of the people that you've run into, why do they wait? And what does it cost them for waiting?
Yeah, and I've been an entrepreneur since the age of 14. Started out in the online marketing industry, now into tax side. But before, going along that journey, I think as an entrepreneur, as a business owner, you just don't know what you don't know, right? And so I see way too many business owners that get into business and let's just say I had a call with someone the other day. They're in this concrete type business. They were working for somebody. They're like, I think I can do this on my own. Never ran a business before, never knew anything about business, but they know they're really, really good at their job. And so they go out and do it on their own. And so they get a client here, they do this one on the weekend. Next thing you know, they got a full blown business. They got some workers working for them, but they're already so far deep into never studying that foundation. They don't know where their foundation is. And so now that first year comes around and they go to their account and they give them all their documents. It's a pile of mess, but their accountant figures it out and works on it and then say, okay, you owe $15,000. That's your tax rate here plus self-employment taxes. You owe $15,000. And they're like, I've always worked for someone, owe money. Like I'm getting a refund the last 30 years of my life. How do I owe money now? And it's just this concept of now they owe money, they did it right, but they're just not used to this concept of having to pay their own taxes, not used to this concept of even thinking about tax planning and how do I lower that tax bill. They just did their business, they spent where they needed to and moved on. But now they have what I call kind of a snowball effect, is that now they understand like, oh, I do need to be planning. I do need to be paying estimated taxes if that makes sense. But they're stuck now paying last year's taxes. So they spend the next 4 months, now they're getting into September and they're paying last year's taxes. Well, guess what? Now they've been earning money since January and they're not paying anything towards this year's taxes. So they start to get into this kind of snowball effect where they're always 1 year behind, and that 1 year turns into 2 years, turns into 3 years, all because they just didn't know. They didn't know what they didn't know. They were in territory that they're not used to. And so, the biggest pitfall I say is just people jumping into businesses without even thinking about the importance of the tax side, of the foundation, of the entity structure, but just getting into business. And, there's so many, especially when you talk contractors, small business, those people that are 1 to 5 employees, there's so many that just go out and get started, that come to me 3, 4, 5 years down the road and say, I got a mess and everything I earn is going to taxes. What do I do? And it's just that fact of they didn't build that solid foundation. They didn't think about that. And some people think too much about it. They get this great protection, all these LLCs and asset protection structures, and then their business doesn't do anything. So I don't want to discourage people from starting a business for this, but it's just take a little bit of time to plan out that right so you can be better prepared for your business. That's going to help fuel that growth of that business too.
Yeah. What about one of the things that my tax preparer told us this year, that it's not our accountant. We're small. My wife has a reupholstering business called Cushion Crafters LLC. Set her up with an LLC, and she's got, people say, oh, I'm doing cushions, and she's doing great stuff. But we went to the taxes this year, and we waited until April or late March, I think it was. And she said, she mentioned we should come back and talk about quarterly tax payments and things like that. So the question is, like most of my questions, there's multiple parts to it, but how should we set up our books? And especially when there's not a lot coming in, so we're not going to hire an accountant at this point or a bookkeeper. We're going to want to do it kind of like bootstrapping. So what would you recommend for someone bootstrapping? And what about quarterly payments and that sort of thing? What should we plan for?
Yeah, exactly. So I always recommend you utilizing some piece of like cloud-based software. So whether that's QuickBooks Online, there's a software that I've loved and really utilized since they came to the US many years ago called Xero, and that's Xero. They're probably the main 2 big players. So Xero and QuickBooks Online are the 2 biggest players in just cloud-based bookkeeping. Relatively inexpensive, I'd say somewhere from $25 to $50 a month. but it will connect to your bank accounts. It'll download all these transactions. All you got to do is go in there and say, oh, this was for that, this was for here. And it provides then the financial reports to that. So for most business, I'd say, yeah, let's set up some type of cloud-based bookkeeping software that can help automate and just organize all those different items. If it's something very simple, like, so sometimes I have somebody that has, 3 transactions a month on a business account, throw it in an Excel sheet or something like that and just kind of organize it that way.
Yeah.
But one thing too is that the way that you're set up, and if you're in multiple businesses, so like if you have a business, your wife has a business, and then also maybe you get into this other kind of side hustle business, we also talk about the correct entity structuring, because an LLC and an S corporation is, once we hit that $50,000-$60,000 in profit, we want to have that S corporation. But let's say, Paul, you hit that $60,000 in profit, and now you're electing S Corp status. And then all of a sudden your wife hits $50,000, $60,000 in profit, and she's electing S Corp status. That's not the ideal. That's not the most tax efficient structure, because now Paul has an S Corp, your wife has an S corporation, you're running payroll under yours, she's running payroll under hers. And also now costs are starting to add up. And so a lot of times it's saying, okay, we have these overall concepts, this concepts of an S corporation, this concept of an LLC. But then how do we paint that into our picture? How do we make sure that we have the most tax efficient structure? And so, what I always say is a business owner that is involved in multiple different entities that they're active in. So take rental properties and any kind of passive stuff out of it. We're talking about businesses that they're active in. We like to see, again, assuming their total is about above $50,000, $60,000, we like to see an S corporation on top. And that S corp is going to own your ownership percentage in other entities. So you could have another LLC that's 100% owned by your parent S corporation. You could be in a partnership with somebody and your 50% in that partnership is owned by your parent S corporation. And so because of all that, you might have 4 or 5 businesses under here that are all flowing through to one S corporation, which then flows through to you, and you're paying one payroll, you're paying one business S corp business tax return at that level. So, first off, yes, get bookkeeping done, do some automation, whether it's a cloud-based bookkeeping software that helps kind of organize those different pieces. But then there's also an entity structure planning that you want to look at once we hit certain levels. Regarding your point of estimated taxes, again, estimated taxes are important and good. I don't want people to think that estimated taxes is tax planning. Estimated taxes is planning for tax paying, if that makes sense. You're paying, you know that you might owe taxes, which is typical. Even folks that we do, and even me as a tax planner, I owe taxes. I don't get it to zero every single year, and very rarely will I get to zero, but I make an effort to get down there. So you're still going to owe taxes, and estimated taxes is just saying, okay, if I project that my tax bill at the end of the year is going to be $20,000, then I need to send every quarter $5,000 to pay that $20,000, because the U.S. is a pay-as-you-go system. And this is something a lot of people don't understand, but they think, oh, I pay my tax bill on April 15th. That's when it's due. The U.S. is a pay-as-you-earn system, which means that you owe taxes as you earn the money. And so if you take that $20,000 and you make no estimated tax payments, that bill that you pay on April 15th is going to include some penalties and interest, because technically you owed $5,000 in the first quarter, $5,000 in the second quarter, $5,000 in the third, and the fourth quarter. You owed that money as you earned it, and you just waited until tax season to actually pay it. That doesn't mean that you get off on that. So there is some interest and penalties, and generally speaking, those interest and penalties don't add up too significantly unless we have very large tax bills. But so those estimated taxes, just saying, here's what I expect my tax bill to be, and here's the payments I'm going to make. And there's different methods on how to calculate that estimated tax. It can just be taking last year's tax bill and making those same amounts. And there's some safe harbors there. If you make, 90% of your current year's tax bill and tax payments, no interest or penalties. If you make 100% of your last year's tax bills and estimated, or tax payments and estimated payments, there's no penalty. So I always give this example. Let's say last year your tax bill was $20,000. So this year you make estimated taxes of $5,555. And then this year in June, you hit the lottery and you win $10 million. Your tax bill is going to be a heck of a lot larger than $20,000. But because you did that safe harbor of $5,555, meeting that tax bill you had last year, you're not going to pay any interest and penalties. Now you're still come tax season, when you're filing that tax return, you're still going to owe the tax, but there's not going to be any interest and penalties on that. So that's what estimated tax payments are doing. It's minimizing the amount that you pay in estimated in interest and penalties. But more importantly to me, it's making sure that you have the funds to cover that. I have a lot of people that say, I'll pay the interest and penalties because I'm going to earn 15% on that money during the year, which is going to be more than interest and penalties. So I'm just going to keep it in my pocket. I'm going to earn on it, and then I'm going to face interest and penalties. I'm fine with that. That's totally fine, and something that I'd even encourage people to do. But that same person, oftentimes, comes tax time, well, they didn't earn the 15%. They spent it, and now they have no money to pay their tax bill. And that's what I don't want small business owners to do, because that starts that snowball effect.
Right. Yeah. The other question I have is, and this is maybe not for business owners, but a lot of my customers and clients that I work with are collecting or are considering collecting Social Security. And in Michigan, they don't charge state tax on social, but they do federal. Obviously, there's federal taxes at the moment. That may change in the future. Who knows? But so what do you do? I mean, you can have the government take the tax out before they pay you, or you can do something else. What do you recommend there? Or is that out of your wheelhouse?
Yeah, this is a good question, and it's something that always comes up, and you'll find arguments both ways or not. I'm a big proponent of overpaying a little bit and getting that refund at tax season. Now, getting a refund in tax season doesn't mean that you paid less taxes. It just means that you kind of screwed up. You gave the government too much money and they're giving it back to you. That's what a refund means. And so a lot of people say never overpay the government, because now they're just earning interest on your money that you could have been earning interest on in the fact. But, I always talk to someone, if you get, say, a $1,200 refund, $1,200 is a decent amount of money. You go out and buy a new piece of patio furniture that you didn't think you could afford or didn't want to afford. You could go buy that with your $1,200 or put it into a savings account. It would be the responsible choice. But $1,200 can add up when you get it in one chunk. But if I tell that same person, okay, instead of getting $1,200, you're going to get $100 extra per month, and it's going to be $50 extra per paycheck. They're not going to recognize that. $50 extra every 2 weeks. They don't even see that. They don't even know what that is. But that $1,200 at the end of the year, that they can get an impact on. And the vice versa, if you have to pay an extra $50 into, estimated tax payments or whatever it might be per paycheck, $1,200 total throughout the year, it's not that much.
No big deal.
But that $1,200 tax bill, or that $12,000 tax bill, or whatever number you want to put out there, that tax bill at tax season, that's going to put a hit on you. So I'm a big encourager of saying, let's kind of overestimate the amount we're going to pay in taxes. Let's not go overboard. I don't want to see you getting a $20,000, $30,000 tax refund, but let's overestimate a little bit, because I'd much rather see you get a little bit of chunk of cash during tax season than have to pay in a little bit of chunk that can really be burdensome, especially for somebody that's, maybe on a limited income or a tighter income, like a Social Security type, earner.
Right. And my clients, that Social Security is supplemental to what else they're doing, their business on top of it. But so the other question that I get is, would it be, should you tell Social Security to take the money out, or should you do it yourself and make that as part of your quarterly tax?
Either way, it's going to be the same treatment of it. I think sometimes when you have, it depends if they have other W-2 income or not, but sometimes it can be confusing you'll say, I didn't pay any money into the government in estimated tax payments, but the government's pulling it out of different paychecks, W-2 here, Social Security here, different areas, and you don't realize it because you get your take-home pay and you think that's it, but there's money that's getting paid out. So sometimes it can be confusing for business owners when they say, well, I didn't make any estimated tax payments. Well, you kind of did, because it came out via the form of payroll. It came out via the form of Social Security. So in some instances, I would say, whichever way you do it, it's going to be the same treatment. In some instances, I would say, hey, maybe just doing it yourself, as long as you're disciplined enough to actually do it, maybe doing it yourself will allow you to be easier to calculate, what you have or haven't paid in without having to look at statements or stubs or different things like that.
Yeah, and I think the discipline is part of the problem, especially for solo entrepreneurs who have they may still be working, they might still be doing a W-2 job, maybe they're transitioning into retirement or whatever, or downsizing their W-2 commitment, and so that discipline is hard to do when you're time starved. So maybe having a systematic approach, whether it would be some sort of sweeping of your account and putting it aside, or simply having Social Security take it out of your check, or some other automated way of putting things aside is a smart move. What do you think about that?
Yeah, and the thing too with estimated taxes is if your business kind of operates the same every year, you have about the same type of income, plus or minus $1,000 here, everything is kind of relatively similar year after year. That's very easy to calculate. Okay, I kind of have an idea what my tax bill is going to be. It's going to be similar to last year. Where you run into issues is when you start to see those big increases of saying, oh, gained a large client this year. So, I have a big shift. Now I'm kind of flustered because I don't really know what my tax bill is going to be. And there's tons of calculators out there. We have a blog, podcast, YouTube video that talks about how do we estimate taxes. And I use a calculator myself where I'll just kind of flip into some income, look at it there and say, okay, here's kind of a rough idea of what I owe at the federal level, what I owe at the state level, and then I'll go and make those payments. So, I always say, like, if you're generally consistent, it's very easy to just get on a cadence of, here's what my tax bill is going to be, whether I'm, whether it's I'm making it now or later, we kind of have an idea what that tax bill is going to be, and I can make estimated tax payments. Where it can be difficult is if you have fluctuations up or down, because now everything's changing. And then a lot of times then I'll go to the safe harbor of saying, okay, as long as I do 100 or 110% of last year's tax bill, I'm good from an interest and penalty standpoint. And that's fine. The problem with that safe harbor is you still owe those taxes if you underpaid. So sure, you're not getting hit with interest and penalties, but you got to come up with the tax money at tax time, which can sometimes for small business owners be the biggest hit because they're not expecting that. They're like, oh, I hit this safe harbor, and now you're asking me for $5,000 more. I just went out and bought a new computer for my studio. So where am I going to use I don't have the $5,000, and that again kind of can start to lead into that snowball.
Yeah, unless you buy a big computer.
Yes.
Yeah. So, for those who are just starting out, what do you do to get started, especially if you're feeling overwhelmed and late to the game?
Yeah, the biggest thing is, when I talk about tax planning, there's learning, which learning is great. We all need to do that. But I always say the problem with learning is it doesn't produce any results. I can learn, and I'm not going to save taxes until I actually go into the implementation mode. And so, we have tons of free content, YouTube channel, podcast, a book, and there's content all out there. I always just say, make sure you're reading and listening or watching or however you like to consume content and learn. Make sure you're finding it from reputable sources and finding it from areas that actually helps you make a difference, helps you actually take action on that. So I always say, get started on the learning, but just make sure that we're not stopping there. And I do this on my own, because I run into the same problem, not on the tax side, but on, marketing side or listening to, these different things. Is I hear something, I'm like, that's really good idea. I need to implement that. And then next thing you know, I take a left turn and now I'm, see a cop, I'm seeing the cop, and next thing you know, I completely lost or forgot about that. And I never get to implementing what that really cool thing really would have been an impact on my business. And so what I encourage people to do is have a note, whether it's on your phone or a notepad somewhere, where you write down different things you've implemented. Like, oh, okay, I heard about hiring my kids in this podcast. I want to do that. So I'm going to write it in this notepad. And then every month I'm going to put on my calendar, check that notepad of implementation things. And so in set time, whether it's a day, a half a day, an hour, 2 hours, whatever it is, set time on a regular basis to go back to that notepad and then use that time to actually implement that. So I heard about hiring your kids. I forgot about it, but now I'm in that implementation stage. Now I'm going to take that hiring the kids and I'm going to actually, do the steps to actually do it. So, learning, first step. Obviously, we need to learn. No one needs to be a tax expert. I wouldn't expect any business owner to be a tax expert, but I expect business owners to have tax knowledge. And that's that kind of core, base understanding of what needs to be done. So do that learning aspect and then step into the implementation piece.
Gotcha. And this has been so helpful to me. I hope our listeners are taking notes, because this is great stuff. Now, as we get towards the end here, I got one question. It's kind of is there a question that you wish I would have asked, and that maybe something you wish more podcast hosts would ask you?
That's a good question. I think that being on podcasts and being a podcast host myself, it's understanding what created this drive for someone to do what they're doing. You're interviewing something, obviously they're either successful or they're a subject matter expert, or they know something about something. That's why they're being interviewed, or they have a story to tell. And I think understanding what brought out that inspiration, what made them become a subject matter expert in a certain area, or what made them that story so powerful, and what was the impact of that change of a story, or whatever it might be, I think kind of helps the audience understand a little bit about the passion around different things people have.
Yeah, and you shared a little bit of that, but maybe we can just dive a little bit more into that. What was the spark that really, you've got a book now, you've got a podcast, you've got a YouTube channel, which is, your podcast and, feeds your YouTube and that, I imagine. And then you've got young kids. So what was it? What was the thing that just said, gosh, I just got to do this?
Yeah, so like I kind of mentioned, I've been an entrepreneur since the age of 14. So I've never been able to, I'm either unemployable or unable to work for someone else. But I started my career at age of 14 in the online marketing industry. And so I was selling my first business, and this isn't really an entrepreneur, but I like to say I was selling things and making money at the age of 14.
You're an entrepreneur. Yeah.
Yeah, I would create these ebooks on how to make a cornhole game. So like the beanbag toss, and sell them on eBay, and it was like $3 a bag. But I'd create these PDFs, and then the PDF would tell you how to create your own cornhole game. Anyways, that led down into different areas of this online marketing industry, and was in that industry for a while. And I was like, well, what happens if this all falls apart? This business that I have running falls apart, and that scarcity that most entrepreneurs have, which never would really happen. But anyways, I said, okay, I want to go to school so I have a backup plan in case everything falls apart. So went to college, got my CPA, and started to work in the business we had. There was 7 partners in the business that I had at that time. And I was working on the finance side of that business. And we got to a point in that business where we had 7 partners, 7 of us, that were all really good at different things in the industry. And we were trying to pull this company in 7 different directions. And so we said, instead of trying to pull this company in all these different directions, why don't we go out and do what we do best on our own? So it was an amicable, really good split, but we all kind of went out and did everything on our own. And that's where I got into the accounting firm. I said, hey, I know this industry well. It's a remote based, everyone's kind of a younger generation working remotely. So I want to do bookkeeping and accounting just like I was doing before, for all the people that I knew in the industry, and got started in that way. And really the problem was that bookkeeping and accounting is great. It's important. It needs to be done, and it can be super, super impactful for your business. But most small business owners I would talk to said, hey, I love the financial aspect here. This has been helpful for us, but I am getting killed in taxes. I am paying most of what I earn in taxes. I need help there. And I couldn't find straightforward, good solutions. And that put me on this journey of another learning of experience, of learning it for myself and for our clients, and started to realize that the information that's out there is either quick hits, like 60 seconds, hire your kids, you get a business expense, they pay no income taxes, go do it. That's not helpful for anybody, because sure, that's a great concept. That's correct. That's accurate.
That's the what.
But how do you do it is one thing. And then the other hit is a brick wall. It depends, that brick wall that they're getting hit. And so, and the other one is an accountant that will explain it to you, and it throws the business owner's head into a whirlwind, because they're using IRS code this, and they're not understanding everything. So that put me on a mission. I started a podcast by accident. I had some YouTube videos. Someone said, why don't you put it on a podcast? So I put it on a podcast, didn't touch it for 9 months. Someone emailed me and said, hey, I love the content and I love the podcast. Had no clue what they're talking about. Finally came remember, oh yeah, I put that up there. And that was my aha moment, that people want this information. And so I started from that mission about a little over 7 years ago, of saying, how can I take complex tax strategies and give them so that folks can get to the 90%. Again, it does depend, but that's only 10% of the strategy. So how do I get people 90% of the way there so that they can then take that, implement it on their own, take it to their accountant, whatever it might be, or utilize another resource to get to that final step.
Gotcha. Love it. So, hey, let's land the plane with 3 action steps listeners can do to take and implement. And we've covered a couple of those. So what are your top 3, Mike?
Yeah. Biggest thing is understanding this concept of tax planning. Make this the year that you're going to spend time now here between January and December to learn the strategies that you can implement, that you can put into place to actually produce tax savings. I always say tax planning with implementation is guaranteed results. I know that if I hire my kids, I am guaranteed to save this amount in taxes in my business based on how much I'm paying them. Guaranteed results. You can't get that anywhere else in business.
No.
So that's one thing is taking tax planning seriously. The second piece is understanding this concept of maximizing deductions. How do I turn after-tax spending into pre-tax spending? Don't go out and buy things you don't need for a tax break. Instead, look at where your spending's being done already. And is there any of that spending that we can move from after tax into pre-tax? That's the second concept. And the third is, again, just kind of taking action on this. Learn and implement. And not just implement, we need correct implementation. Because you can take something that is black and white legal in the tax code and implement it incorrectly and turn it illegal. I always talk about the home office deduction. Home office deduction, the government wants you to use it. It's there for a reason. The government wants you to use it. But if you go and file your tax return and say 85% of my house is my home office deduction, well, you've just taken a strategy that's there and available to you and abused it and turned it into something that could easily get audited and disallowed. So it's understanding, learning these tax strategies, but then understanding what are the bits and pieces that you need to put in place to correctly implement it, to make sure that it can stand up, documented, everything's good. And even if the IRS comes knocking, you have nothing to worry about because you have that documentation, that clarity to know that it has been done correctly.
Gotcha. Awesome. So you've got some more resources. So you've got the ultimate guide to maximizing business deductions and write-offs. Can you tell us about that and how to get it?
Yep. Go to Tax Savings Podcast. So www.taxsavingspodcast.com/deductions. And you can download that free ebook we have.
Okay. Well, Mike, when I saw Mike Jesowshek, did I say it right? Jesowshek, sorry. When I saw that in CPA after the name, I went, oh my gosh, this guy is going to be boring. He's going to be not any fun. But yeah, I guess, tax savings, when we think of tax savings, it's going to be, it's just going to be boring. This has been great. This has been uplifting. You certainly have simplified and done what your mission is to do, simplify complex tax strategies and make them simple so the rest of us who aren't tax professionals can understand it. So I really, really appreciate it, Mike.
Yeah. Thanks, Paul, for having me. It's always fun.
Yeah, it's great. So as we sign off, remember, faith and action go hand in hand. So keep the pedal to the metal. Until next time on the Lead Machine Growth Show, I'm Paul Guyan, your host. And Mike, thanks so much for coming.
Thanks, Paul.
Thank you for tuning in to the Lead Machine Growth Show with Paul Guyan, where we show you how to tackle your tech, master your message, and design your dream so that you can transform your vision into reality. Remember to visit our website at www.leadmachinegrowthshow.com and enjoy even more great episodes like this one. Again, while you're here, subscribe to us via your favorite network. We look forward to seeing you next time on the Lead Machine Growth Show.